Srikanth Subramanian, CEO at Private Wealth Investment Advisory, Kotak Advisors, is now with us. Srikanth, what are the conversations that you are having with different kind of HNI clients? What are the queries that they are making at this point of time? Which are the sectors that they are talking about?
The bulk of our conversations these days are, as you would assume, are revolving around how investors should navigate these fast moves in the market. We saw in less than 8 to 9 months, markets go all the way from 12,000 Nifty to 7,600 and very quickly climbed back to almost a 13,000, 13,500 sort of level. So I think bulk of our conversation is revolving around investors wanting our view and help and advice in terms of how to navigate through these times where the moves have been very fast. And interestingly, the second part of conversation is on the absolute divergent asset class, which is fixed income, where also because of the abundant liquidity that has been sort of pumped in globally from all the central banks, your options as an investor for investing into safe fixed income instruments have really sort of dwindled more from a point of view that your interest rates have really come off. And on top of that, as we are all aware, that the tax rates for debt instruments in India is also not as favorable as the tax rates for equity is. So for an investor, after accounting for tax and after accounting for inflation, the real returns for most of the investors without having to dilute credit quality has come down to almost negative returns. So I think to that extent, the conversation is also going around the entire space of fixed income. And I think the last part is because of these two asset classes, which have been the more dominant asset classes for both fund managers, asset allocators like ourselves, advisors like ourselves, and also investors being in an uncharted territory, the discussions have started moving on to what are the alternatives to both traditional equity and traditional fixed income. So discussions around, is this a good time to diversify into international investments? Is it a good time to look at the unfolding tech startup culture in India, which many of the Indian diaspora had actually sat out while many of the foreign funds came and sort of embraced it. So I think we are seeing conversations partly because many investors have started believing that it's time for the Indian unlisted space to start unfolding, and part driven by yield chase. So conversations have also moved to alternative asset classes.
Historically, affluent ultra HNIs have a large section of their portfolio in the real estate, fixed income, very little in equities. Now with equities being in the bull territory and expansion phase, is there an urgency to buy this?
I think that changed about 2-3 years ago, when the structural change in India started making a stronger case for investors to move from, let's say, fixed assets like traditional assets like real estate into more financial assets. I think the conversations had started turning a page even during that time. But of course, yes, with investors somewhere looking at returns dwindling from real estate, it continued even in the last 2-3 years, and also fixed income. I think investors are looking at, I wouldn't say increasing equity exposure, but really sort of staying the course. I think with each of these market outliers, if you will, 2008 being an outlier, 2013-14 being an outlier on the upside, and now we're again seeing a market outlier due to the pandemic. I think we are seeing investor maturity getting stronger and stronger. I don't think investors are really sort of moving out of equity as was the case early on, where investors used to move very quickly from equity to fixed income if the markets were sort of in a very volatile territory. And I think partly the industry also alluded to that. I think what has happened is most of these investors, most of the fund managers, most of the asset allocators have really taken the concept of asset allocation in the right vein and spirit. The allocations to equity are clearly for more mid and long term. And we are seeing that happen. We're not seeing capital shifted out because of sharper corrections,
Right.
investors waiting out. And of course, yes, what you say is true, more because of the fact that if most of the investors feel that debt markets have not been able to give them the returns that they were expecting, there the inquiries have started increasing.
What is your call on the market? Is it difficult to predict where it is headed? What is the kind of investment landscape in terms of earnings, valuation? What are your thoughts here?
We took a call very early on. We actually took a call somewhere first fortnight of March, where we realized that this is an uncharted territory completely, and we somewhere took a very sanguine call that to play out this kind of a crisis, we should have a very open mind. So just before the pandemic hit India, even when we were even less than 500 cases, we had given a call. We used to be overweight equity at that point of time. We had just given a call that we want to cut all direction bias as far as navigating this crisis is concerned. So we gave out a call where we reverted to mean, we cut our overweight positions on equity, and we stayed put on neutral. After that, every month when we deliberated internally, we realized that this kind of a market, we wouldn't want to be a victim of taking too many calls as far as market timing, giving directional biases to investors are concerned. And we continue to hold the neutral position. We held our neutral position all the way when the markets corrected. We held our neutral position all the way when the markets went up. But we never gave into the temptation of calling a particular timing or an entry point or an exit point in the market, because we realized soon enough that this is really not a crisis that has to be navigated by financial experts. This is a crisis where even financial experts have to get their macros from experts in the healthcare industry. So we took three calls. We took a call that we will not get into deep market timing calls. We also took a call that we will not have huge sectoral bias. And I actually...
International investing, are you getting clients to play the US market as a part of international investment, or you have non-US, non-tech as a part of your portfolio?
So by and large, since this is a slightly more novel concept in India, we've traditionally, all of us have been very inward looking, and over the last half a decade or so, through areas such as liberalized remittance scheme, through areas such as feeder funds, we are now seeing Indian investors really wanting to diversify portfolios. So since it's still a nascent concept, we haven't really we decided to play it slightly more broader. So I think currently our call is largely US. We are looking at some of the other markets, be it Europe, be it Japan. But I think at this point of time, given the fact that it is still in its last leg before we are able to get slightly better clarity, the international equity call is largely in US. But within US, we've taken some calls of split between technology and more conventional US. So we are currently skewed towards a 60-65% as far as US technology is concerned, and 30-35% towards broader index as far as US is concerned.
Wanted to understand your thoughts on fixed income. It appears to be a part of the portfolio, but at the same time, the yields are coming down. What is your opinion?
Our both request and advise, it's a stated position, is to don't give up on patience just as yet, because fixed income is a very asymmetric asset class. If we take the wrong risk, we can lose our capital. So that is one area where we've always believed that as far as fixed income is concerned, even though the yields are brutally low at this point of time, but just to chase yield, it's not the best time to either dilute credit or to increase duration. Those are the two common levers that investors have as far as adding returns to fixed income is concerned. But given the overall headwinds in the market, I don't think this is just the time to really go deep as far as diluting credit is concerned, or as far as increasing duration is concerned. I think it's a well-known fact that we are almost at the very end as far as the bottoming of interest rate is concerned. That does not mean that timing wise we are at the end. It may stay here for quite a bit, but it's clear that at some stage, whenever that happens, 6 months, 9 months down the line, if interest rates start to harden, longer the duration, the more hammering that a debt portfolio can get. And on the other side, if we give into the temptation and start diluting our credit at this point of time, and let's say some blowouts happen, and we keep hearing of some blowouts here and there, it could sort of spread into the credit spreads sort of widening, and which again can manifest into some sort of an NTM loss in the portfolio. So I think on the fixed income side, we are still exercising caution, even if it means that for some periods of time, we are sitting on slightly low return. But at this stage, I think the premium is to be put on a lot of safety. Premium has to be put on reasonable liquidity, and be aware that as and when there is slightly more sanity that is there in the market, when rates are of slightly better level, one should start coming into fixed income with a little more gusto. At this stage, we are slightly more skewed towards a 3-year to 4-year good quality, AAA quality credit portfolio. For some correct risk profile, for about 10 to 15%, we do look at some alternatives. It is not a substitute. There are different risk profiles, but after full understanding, there are very credible alternatives such as REITs in India, but for the right investor temperament and with the right understanding of risk, some allocation we are looking at into some of these asset classes that are now emerged in India.